All right, today we are pulling back the curtain on what really makes a company tick. We're going to look past those flashy profit numbers you always see in the headlines and zoom in on the one thing that never ever lies: cash. Let's get right into it.
So, let me ask you a question. What do you think is a company's most important number? I bet your mind immediately goes to revenue, or maybe net profit, right? I mean, those are the obvious answers, the ones that get all the attention. But what if I told you the true sign of a healthy business is something else entirely?
And here's exactly why. On one side, you've got reported profit. Now, it's important for sure, but you have to think of it more like an accounting opinion. It can be a little misleading. But on the other side, you've got actual cash flow. This is not an opinion. It's a cold, hard fact. It's the real money hitting the company's bank account. Think about it. A company can report a $1 billion profit, but still go bankrupt if it can't pay its bills with actual cash.
And that brings us right to our first big idea. Profit isn't the whole story. That huge net income number you see on the news, it's just the start. To really get to the truth, you've got to dig a little bit deeper.
And listen, this isn't just my opinion. This is how the smartest minds in finance operate. They know that accounting profits can be, well, a bit abstract. But cash is the ultimate judge. It's the final word on a company's health.
So let's meet the first key number on our journey today. This is called operating cash flow, and I love this one because it's like looking at the true engine of the business. It tells you if the core business model is actually spitting out cash.
So, to put it simply, operating cash flow, or OCF, is just the cash a company makes from its main, day-to-day business. Actually selling its products or services. It strips out all the noise from things like investing or financing. It really just answers one simple question: is this business generating more cash than it uses?
Okay, so how do you even find it? It's actually a pretty simple three-step recipe. You start with that headline net income number. Then you add back expenses that weren't actually cash, like depreciation. And finally, you adjust for a few other things, like if a company is waiting on a customer to pay them. We're basically just taking that accounting number and correcting it to show the actual cash reality. Now let's take it to the next level. Once we know how much cash the engine is generating, we can find what's called free cash flow. And this, my friends, is the real prize. This is the cash that's left over for the owners of the business.
So, free cash flow, or FCF, is what's left after a company pays for all the things it needs to maintain and grow itself. We're talking new factories, new computer servers, new equipment. This is the truly leftover cash that they can use to do things like pay dividends, buy back their own stock, or acquire another company. It's a huge sign of value creation.
Let's make this super clear with a quick example. Let's just imagine a company's business engine, its operating cash flow, generates a massive $100 billion in 1 year. That's the total cash pile from its core business.
But wait, you can't just pocket all of that. You have to subtract the money it costs to keep the machine running and, more importantly, growing. We call this capital expenditures, or CapEx for short. This is the cost of new data centers for a company like Microsoft or new gigafactories for Tesla. So after you subtract those necessary investments, you're left with $70 billion in free cash flow. See? The formula is that simple. Operating cash flow minus CapEx equals free cash flow. And that number, that shows a company's real financial firepower.
All right, now for the really fun part. Let's take this secret lens of ours and use it to look at some of the biggest companies in the world. Because when you look at their cash flow, it reveals their hidden strategies. It tells a story that profit alone just can't.
So take a look at Amazon back in 2022. Its business engine generated a whopping $46.8 billion in operating cash. But then, they turned around and spent an even more massive amount on building out their empire of warehouses and data centers. And what was the result? Well, as you can see, their free cash flow was actually negative $11.6 billion. This is their strategy in plain sight. They're sacrificing short-term cash to achieve long-term dominance.
Whoa, now this is a totally different story. Just look at this hockey stick growth in NVIDIA's free cash flow. For years, they were a solid, healthy business. And then the AI boom hit, and in just a couple of years, its FCF just exploded from under $4 billion to over $60 billion. This isn't just profit on a spreadsheet, this is a true gusher of actual cash. It just shows how their dominance in AI chips turned directly into raw financial power.
And Tesla's story is a perfect example of this whole life cycle, told in cash flow terms. If you go back to 2017, they were burning through billions of dollars in cash to build their gigafactories.
But investors kept funding this cash burn because they believed in the strategy. And look what happened. In 2019, they hit this incredible turning point, finally generating positive free cash flow. And by 2022, they were a full-blown cash machine.
Now, a quick but really important warning here. For some businesses, like banks, the rules are kind of different. See, for a company like JP Morgan, making more loans, which is their main job and a sign of healthy growth, is technically a cash outflow. So that can make their operating cash flow look negative even when they're doing great. It's just a good reminder that context is always key.
Okay, so how can you actually use this powerful lens for yourself? Let's wrap this all up with a simple checklist that you can apply to any company you're interested in.
Here are the 5 big questions to ask. First, is their operating cash flow positive and ideally growing? That means the core business is healthy. Second, how does it compare to their net income? If it's higher, that's usually a great sign. Third, what's the trend in their capital spending? Are they investing in growth? Fourth, is their free cash flow consistently positive? And finally, how are they using that prize money? Are they rewarding shareholders, paying down debt? This tells you everything about what they care about.
So when it all comes down to it, here's the crucial point. Looking at cash flow takes you way beyond those simple profit numbers. It gives you a much deeper understanding of a company's strategy, its health, and its true financial reality.
So I'll just leave you with this one question to think about. The next time you see a big, flashy headline about a company's record profits, what's the real cash story you're going to go looking for? Thanks for tuning in.